Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Monday on this Thanksgiving week. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So I wanted to do a market update focusing on Donald Trump's selection for Treasury Secretary, explain why that has been good for mortgage rates, and also talk about what's up ahead this week and especially next week, what I think are going to be the biggest movers for mortgage rates. So in my last video, I talked about which policies of Trump's could affect mortgage rates, and mainly how most of the proposed policies would be inflationary. However, it's worth mentioning that he has also proposed cuts to federal spending, which would be good for mortgage rates. Cuts to jobs would be non-inflationary, therefore looked upon favorably. Trump has appointed Elon Musk and Vivek Ramaswamy part of DOGE, the Department of Government Expenditures, which is kind of an informal department. And so last week, when they penned an article in the Wall Street Journal proposing about $500 billion in annual cuts to government spending, the market really didn't care. There was no discernible movement. If that actually happened, that would be good for mortgage rates. However, on Friday night, and this has really only started to have effect today because the markets had closed by the time this was announced, Trump announced the appointment of Scott Bessent to Treasury Secretary, and that has been very well received in the bonds market for both the Treasury prices, which have gone down, and mortgage rates, which have also gone down. And the reason for this is Scott Bessent is very much an investor-minded guy. He has worked for several big hedge funds, George Soros. He started his own hedge fund in 2015. He is very understanding of what is going to move the numbers, and I think he is viewed as a steadying hand, not someone who is going to do anything crazy or outlandish. I think he is kind of viewed similarly to Jerome Powell, which is someone who is going to do what they feel is best for the economy, not necessarily be a puppet for Donald Trump if they disagree with the direction he is thinking of. Early indications show that Scott Bessent is pushing more production of oil, less regulation, which are things that would likely stimulate the economy. Less money going to gas means you're spending on other things, and less regulation means much more company spending and much more growth. However, he's also balancing that with an expectation of less government spending. And I think unlike with Musk and Ramaswamy, who markets aren't sure how much of an effect they'll actually have, how much power they actually have, and B, I think the markets view them as kind of not actually influential, whereas clearly Treasury Secretary will have real influence and real say-so, and what he's proposing, I think the market, even though it may not be quite as aggressive and wide-reaching as the DOGE committee is proposing, it's much more likely to actually be implemented, and that's why I believe the market is reacting the way it has. Looking ahead, this Wednesday we have the Fed's preferred method of inflation, which is PCE, or personal consumption expenditures. We also have another initial jobless claims report, which will kind of preview where things are heading for next week's data on unemployment rate. PCE data usually follows CPI, so it's most likely going to come in about the same for core PCE inflation, and I would expect an uptick in overall PCE inflation. I don't think the market is going to react very dramatically one way or another. The jobs data has very clearly been the biggest market mover. And if anything, I think an initial jobless claims report that comes in far from the expectations is more likely to move the needle. Next week, we have the combination of ADP employment, unemployment rate, and U.S. employment, which is also known as non-farm payrolls. And that will paint a clear picture of the availability of jobs and the unemployment rate. And if it comes in right as expected, maybe that we're going to stay where we have been the past few weeks, which has been like high 6s, low 7s very consistently. But any swing one way or another is very likely to push the probability of what the Fed will do in December one way or another. Right now, we're at like 52% likelihood of a 25-point rate cut, 48% of a rate pause. Depending on those jobs numbers, that could swing one way or another very quickly. Maybe in one day we go from 50-50 to 80-20 or something like that. If anything pops up like this Treasury Secretary appointment, where something that I wasn't expecting to move the needle so much does, I'll certainly put out a video on that. But as always, if you have any questions or comments, leave them below or feel free to call, text, or email me. But thanks for tuning in to this video, and have a happy Thanksgiving, and I'll see you next time.